Good morning, everybody. I'd really like to welcome you to an interview with Adam Blumenthal. Adam has been involved in the employee ownership and employee participation world for over 30 years. And in fact, he was one of the founders and senior executives of the first public vehicle to invest private capital in employee-owned businesses. And that goes back over 30 years ago. So we wanted to give you that historical perspective because we are really privileged to have an executive who's had such experience to talk to us. So to begin,
and I should say that we knew each other back 30 years ago. So whatever you're saying about
that is true. Adam, maybe you could share how you got involved in this world. You've had a lot of experience, and maybe, what brought you into it? Was it chance? Was it motivated? How did it happen?
Yeah, sure. So, I got out of college, started working in the early mid 1980s. And, it was a period of time when major trends in the economy included, the rise of global competition, decline of American manufacturing, the introduction of things like lean manufacturing and quality on a global basis. And, America had a lot of issues sort of coming up to speed with all of those changes. And there were some pretty negative impacts on industrial America and the American heartland. I was very interested in, preserving those jobs, preserving that base, and maintaining those companies and being able to thrive. In the steel industry, a unique partnership emerged between the Steelworkers Union and many of the large companies at the time to use employee ownership and participation as a way of restructuring the way those companies worked to help them be competitive for the long run. And I was really inspired by that, and learned a lot about how it worked, and then started doing similar transactions, both in the steel industry and in other industries. And that really was the beginning and foundation of my career.
And when you started, how did you get into direct investing? Because when you started it, you started as a financial advisor and an investment banker. Is that correct?
Yeah, we had always believed that American capital in the early days in the potential of these companies to perform extremely well. And so although we bootstrapped the company, right, to the extent that we had any ability to do so, we would always take our fees in the form of equity in the companies. And as that portfolio grew in value, we were able to leverage it and actually invest cash in companies and really build up a portfolio of initially minority equity interests in ESOP companies. And it was really the strength of that track record, the history of those companies and the performance of the equity that gave us the track record that allowed us to take the company public in an IPO. And I would say none of us at the time had Wall Street backgrounds. The private equity industry was, quite nascent at the time, and not the huge thing it is today. So you think back to 1980, 1990, 1995, very few private equity funds, very specialty things. We tried to raise a private equity fund to do this, couldn't. But the public markets actually were quite embracing of it. And, so that's how we wound up raising the capital.
You mentioned that you had confidence or, felt good about the growth prospects of the businesses that you were putting together. Was employee participation, was it more strategic, or did you believe that employee participation would provide value, if you will, to the growth and development of the organization, as well as being good for the employees from an economic perspective?
Yeah, look, I think So let me unpack that question a little bit. Well, one is there's a broad range of outcomes in the performance of employee-owned companies. There are management styles that include open book management, participation, communication, and the use of the incentive nature of the ownership stake as a way to really, to build a company culture. And, in general, whether that's in, a steel mill that's being, brought to competitiveness, or whether it's in a Silicon Valley startup with which everybody's sort of familiar, leading and managing a company with that culture is a very powerful thing. And where you have the right leadership and the right culture, you can really use it to build competitive advantage against your peers. And we certainly believed that was true. We saw it happen many times, and we wanted to be part of those companies. It's also true that the motivation for implementing employee ownership goes beyond its economic effects, right? That certainly people people do ESOPs because there are tax advantages to them. That has always happened, and that's still part of it. It's a seller thing, and not doing it to, create a different culture or competitive advantage. And there are also, values-based and political reasons for that many people are interested in it, having to do with access to opportunity, to equity opportunities, more broadly for people throughout society. And of course, those values, I think, motivate a lot of people with an interest in employee ownership. Not everybody, but certainly a disproportionate contingent relative to people interested in capital markets in general. And so all of those things were in our heads, but certainly we wanted to, we're investors. We wanted the investments to do well. We certainly were prepared to take equity in companies where leadership was building a competitive culture involving ownership and participation. And we were proud to do it, both because the companies did well and because they were well aligned with our values.
Great. That's great. Maybe now we could turn a little bit because it has been 30 plus years. You are managing now quite a bit of private capital. I think primarily in the form of equity funds. You don't have any debt funds, do you?
We're purely, we manage a series of private equity funds. We manage about $2 billion at the moment.
Maybe you could share with us, how and if some of your investing over the last decade or so has touched on some of the issues you just enumerated, maybe give us a story or two, if not from this particular series of funds, from maybe American Capital, that would explain, a success.
Yeah, sure. So certainly, there was a template of transaction that we would do at American Capital that that generated some pretty good returns for people. I can think back to, the very first investment that we made, company that I worked on, fresh out of business school, a corporate carve out of a company called Lloyd's Lumbers from a publicly traded company called the American Maize Products Company. I don't think it exists anymore, but it was an American Stock Exchange company. The senior management there had decided to divest this division. They had given the management group the opportunity to make a first competitive offer for the business. We met them. We structured a transaction. It was not a huge transaction. It was a $20 or $30 million transaction ultimately. A group of perhaps a dozen or 15 lumber yards throughout central Pennsylvania, maybe 300 or 400 employees. What we were able to do with the management team was educate the employees as to what was going on, what management intended to do, how they intended to promote the company, how they intended to operate it, how they intended to communicate with employee shareholders. We said that we would give all of the employees an ownership stake through an ESOP. And at the time, there were very substantial tax advantages to doing it. So it basically made the company not be a taxpayer. And in addition, we would give the employees the opportunity, if they wanted to roll over a portion of their 401k savings, the employer contribution that had been made over the years. We give them the opportunity to roll that over into the ownership of the company as well if they wanted more exposure. So we didn't use the whole fund, but we did give them the opportunity to take some of what they had accumulated and roll it over. We did a registered offering. Turned out a lot of people were interested in that, and that allowed us the employee rollover equity plus the broad ESOP that included everybody to create a new company, make a very competitive offer, and create a new company that became independent. And that company has continued to this day, honestly, 30 years later, as a pretty vibrant employee-owned company in central Pennsylvania. We still drive by their stores periodically. But the principle of transparency from the beginning with the employees, I think giving people the voluntary opportunity to increase their participation, and then a commitment to things like quarterly brown bag meetings and transparency on metrics and financial information, structured participation program. All of those things really, they use the transaction as a catalyst to implement that kind of a culture and management structure. And it served them quite well, in a rapidly consolidating industry where today you've got Lowe's and so on as competitors. But if you have the right culture on the right employee base, you can make it work. And so that turned out, I always like it when I drive by one, because it literally was the first transaction that I worked on ever, and worked out really well.
It's really exciting. And today, are they still 100% employee owned, or did they have to bring in investor capital for some portion of their capital structure?
I don't know the answer to that question. I know there's still employee ownership there because it's on the signs, but 30 years later, I'm sure it's run by people I don't know, and I'm not on the inside of that anymore.
But I think the unique part about it is we're looking for sustainability. It goes to some of the things that you talk about. It used to be that businesses were rooted in communities, families owned businesses, even if they shared participation, and that provided a lot of stability to the local economies. And today, I think people think employee ownership could be a vehicle for creating some of that stability, both for employees and communities. That's a great story.
So, John, I'll fast forward to today if I think that's where you're going with
That'd
this.
be great. That'd be great.
And so, look, in terms of managing I'm saying in terms of managing Blue Wolf for the last 15, which is what I've been doing for the last 15 years. We manage a couple of $1 billion. Many of our investments have been in these kinds of heartland America companies. We started a sawmill in Glenwood, Arkansas, remediated environmental issues around a sawmill in Dixie County, Florida, put them together and made them part of a big public company. We operate paper mills in upstate New York and Maine. We operate significant healthcare companies really nationwide. These are very employee-rooted companies. Many of them are very community-based companies. We have typically not incorporated employee ownership over the course of the past 12, 15 years we've been doing this. Because honestly, in the labor markets that we were in, paying competitive wages seemed to be what employees preferred. There certainly are very participatory cultures. But with reduced tax benefits over the years, despite the fact that I spent the first 15 years of my career doing employee ownership transactions, the last decade or so, really haven't done any. And that's about to change. And I can't give you the name of the company. We haven't unveiled it yet, but Friday of next week, I'll be somewhere in mid-America at a plant opening and unveiling for a 1,500 employee global manufacturing company a commitment to broad-based employee ownership in a way which, if we meet our underwriting criteria, will be quite meaningful to all of the employees, every single one. And the reason that we're doing that, gets back to what I said at the very beginning of this conversation. In today's environment, coming out of COVID, right, we're confronting things, people call it the great resignation. At the same time, we have very, low unemployment and worker shortages. So people at the same time say everybody quit their jobs and say there are no workers. So, somehow if people can think both those things are true at the same time, nobody understands what's going on, right? So we are dealing with an unprecedented labor market situation that everybody, that has to do both with changing culture and preferences on the part of workers, as well as structural changes to the economy. We think that's a very good time to introduce the kinds of principles of employee ownership and participation in terms of building competitive cultures, loyalty, mission, and giving people a reason to stay and be part of a company with whom they have, aligned economic benefits. And I will also say that, many of us can look at what's happened to inequality in society over the course of, the last several decades, and certainly the last few years in particular, and say, this is not really sustainable, right? This is like, you can't draw out these trend lines in these directions for very long before things seem like they couldn't possibly work. And so, broadening ownership and finding ways to, build a culture and economic structure that's competitive, but that addresses that issue also seems to us like, an important thing to do in terms of building a long-term sustainable economy. And so for both those reasons, labor market issues, building a competitive company, and addressing long-term, what's the role of private equity in an industrial economy, all of those make us feel like this is the right time to be doing more of it.
That's a very prescient in terms of thinking of the future. I think the last thing it would be helpful to hear you comment on for the audience is how do you think this idea of participation, has it grown? It's always sort of been a niche idea, with a few well-known investors who understood its value. You've talked about a much broader reason for employee participation, but in terms of the consciousness of the financial community, do you have a sense, is it still a niche business? Do you see expansion in the idea? Do you have any perspective on that?
Yeah, look, I think the entire financial community is wrestling with the phenomenon that gets referred to by the letters ESG, right? And environment, which means environmental, social, and governance aspects of investing, and means a million things to a million people. There's the United Nations Principles for Responsible Investing that helps define it. European pension funds seem to think it's very important. American institutional investors, more ambivalent. American retail investors, I think, wanting to see what it means. So if you look at the website of a global wealth manager like UBS, like everything says we are conscious of, ESG factors. Within that, so there is an openness because of the concern, the recognition the capital markets need to take ESG factors into consideration in some way. I would say there is an openness to the S in ESG, social, is all about how employees are treated at work, what is the relationship of employees to work, how are incentives and capital organized. Will employee ownership prove to be a meaningful component of that S as people think it through? Or is it really all going to be about worker health and safety, or community impacts in some other way? Look, I don't really know. I think it's really up to people who are employee ownership proponents, right, who think that this is a big contribution to that, to invest and create the models and the returns and outcomes, honestly, that would make employee ownership and participation a big piece of that S. Because the ESG movement is definitely going to have an impact on how people invest. And it's kind of up to us to prove that this is an important part of it.
So really, it's a very positive way to end, in that it's very possible that the investing world, being driven by people who are asking for a new set of values, it could potentially have a big impact on the future of investing and providing more participation for employees. Is that a good way to sort of?
Absolutely. I think the world is listening. We got to figure out what to say.
Okay. Hey, Adam, thanks a lot. It's been a pleasure.